The RV market just imploded. 3 million used rigs dumped at once, and prices are crashing to literal pennies. Dealers are drowning in inventory, banks are cutting credit, and owners are watching their resale values disappear overnight. Too many RVs, not enough buyers, and way too much debt. But here's the part nobody's telling you. The next 30 days could decide who loses everything and who scores the deal of a lifetime. Let's get into it. The 3 million shock. It began quietly, then all at once. 3 million used RVs flooded the American market, and prices collapsed faster than anyone predicted. At dealer auctions from Indiana to Arizona, rows of Class A and Class C rigs now sit shoulder to shoulder, their windshields plastered with "Reduced Again" stickers. A Jayco Eagle that once sold for $108,000 hammered last week for $38,400. Another Winnebago View dropped from $156,000 to $67,000 in just 90 days. These are not sales, they are liquidations. Every VIN tag and slip of paper tells the same story. Too many rigs, not enough buyers, and banks demanding repayment. So why is it happening now? The pandemic leasing boom created a time bomb. Between 2020 and 2021, families and rental fleets signed long-term contracts assuming the demand for road travel would never fade. Those leases are expiring at once, pushing millions of depreciated units into the open market. Fleet managers who once bragged about record occupancy are now offloading vehicles in bulk. Dealers can't absorb the volume, and storage yards are full. The glut has arrived, and when the financial fuel dries up, the whole engine stalls, starting with the banks that built it. When banks pull the plug, every dealer lives on borrowed time. They don't own most of the rigs sitting under those bright showroom lights. The banks do. This arrangement, called floor plan credit, lets dealers rent their inventory day by day, paying interest until each RV sells. During the pandemic boom, that seemed harmless. Stock moved fast, rates were low, and lenders were generous. But when prices turned south, so did the math. A leaked memo from one national lender shows why. Interest rates on dealer credit lines jumped from 5.9% to 9.8% within a year. That single change doubled carrying costs overnight. Dealers now bleed thousands each week just to keep units parked. Some have begun paying interest with service department revenue or personal savings, hoping sales will return. Others quietly surrendered keys to the bank. Each repossession adds another RV to the growing pile already choking auctions. For consumers, it means trade-in values are evaporating. A rig you bought for $80,000 might now earn $45,000 on a good day, and that's before dealer fees, financing. A new one has become nearly impossible unless you bring major cash up front. With lenders retreating and stockpiles swelling, the next chapter of truth unfolds, where desperation meets the auction block. If you're already seeing RV prices crash near you, hit like and drop a comment with what dealers are offering. Auction Truth Serum. Auctions don't lie, they strip away emotion and expose what the market is truly willing to pay. In October of last year, a late-model Tiffin Allegro averaged $112,000 at wholesale. By January, identical units cleared for $66,000. That's a 40% drop in 90 days. Across all categories, motorhomes, towables, and travel trailers, the decline ranges between 40 and 60%, depending on mileage and condition. Dealers may still list inflated retail numbers online, but behind closed doors, they're accepting far less. At the Manheim Lanes in Indiana, a Class C coach that once drew a crowd now attracts cautious bidders counting repair risks instead of features. Buyers whisper about rising floor plan defaults and question whether titles are clean. Even banks sending repos to auction sometimes skip reserves altogether, preferring quick cash over longer losses. The gap between retail illusion and wholesale reality has never been wider. Your 2-year-old rig could be worth half what you owe by the next billing cycle. Those hoping to sell privately are meeting buyers who arrive with auction screenshots as proof of what they should pay. Every sale sets a new low, and every low drags the rest down further. The truth is brutal, but clarity is power, if you know what to look for. Yet among the bargains and markdowns lurks a more dangerous problem, one that you can't see from a price tag: the rise of zombie RVs. As inventories overflow, damaged and title-washed RVs are slipping into circulation disguised as steals. These zombie rigs look clean, smell fresh, and often carry a fake history. Many are flood survivors from hurricanes across the Gulf states, rebuilt quickly, sprayed with scent, and shipped north with scrubbed paperwork. Salvage titles are legally converted through small state loopholes, leaving buyers with what appears to be a normal registration. Inside, mold spreads through insulation, and wiring corrodes silently. 6 months later, systems fail, brakes seize, and the so-called bargain becomes a rolling liability. Insurance data confirms the danger. Claims for post-flood electrical fires in used R-vees have tripled since mid-2024. Records show more titles being reissued with missing info, a common hint that the vehicle was once damaged and rebuilt. In one example from Louisiana, a batch of 30 motorhomes listed as dealer transfers were traced back to a hurricane loss lot. Families who bought them are now fighting warranty denials and facing repair bills that exceed resale value. Match every VIN against state databases, demand maintenance logs, and inspect undercarriages for rust lines or water stains. Real bargains exist, especially older pre-def diesel models and fiberglass roof towables, but due diligence decides the difference between value and disaster. The market may tempt you with under $5,000 deals, but the cheapest rig on paper can be the most expensive mistake of your life. And while buyers wrestle with hidden damage, factories keep building as if the flood never happened, setting up the next wave of pain still to come: factory greed. When the lockdowns ended, the factories went into overdrive. Executives looked at the surge of R-vee demand from 2020 and 2021 and believed it would never end. They called it the new normal and bragged to investors that Americans had rediscovered the open road forever. But those rosy projections turned toxic fast. Production data from the Recreation Vehicle Industry Association shows that between 2021 and 2023, shipments jumped nearly 70%. Lines ran 24 hours a day, and suppliers couldn't keep up. Managers rushed to fill backlogs, ignoring the warning signs that interest rates were climbing and fuel prices were about to spike. Every coach built during that frenzy was a promise the market couldn't keep. Dealers cheered at first because fresh models meant new commissions. But behind the scenes, executives kept pushing volume even as dealer lots filled. They called it momentum, though the truth was greed. They needed quarterly growth to satisfy shareholders, not customers. Now those overbuilt inventories sit unsold, and the fallout lands squarely on owners trying to resell. The resale charts don't lie. A rig purchased in 2022 for $180,000 now lists for $95,000 at best. Oversupply has crushed residual value, wiping away equity faster than any recession could. And that pressure doesn't hit evenly. It's carving a brutal line between big city markets and the small towns that built the dream. Urban crash, rural squeeze. In major metro areas, the R-vee collapse looks like a clearance event. Billboards scream final markdown, and suburban dealers compete to dump units before the next payment cycle. It's a race to the bottom, but at least buyers exist. Cities have population density, disposable income, and easy access to financing. Discounts pile up because competition is fierce, but lights stay on. Out in rural America, the story changes from discounts to desperation. The very counties that fed the boom are now starving from it. In Elkhart, Indiana, the capital of R-vee manufacturing, temporary layoffs have turned permanent. Plants that ran 3 shifts a day 2 years ago now sit silent except for security lights. Local diners once packed with welders and painters now close by sunset. County tax bases are shrinking, starving schools, and police budgets. These aren't numbers on a spreadsheet. They are paychecks gone missing, mortgages falling behind, and families wondering how to keep health insurance after the plant shutters. When locals step back, the vacuum doesn't stay empty for long. Wall Street always finds a way to profit from someone else's loss. Wall Street exit. On trading floors, the R-vee meltdown looks like just another correction. Fund managers glance at spreadsheets, see profit margins evaporate, and quietly rotate out of the sector. In the last 12 months, shares of Thor Industries have fallen nearly 45%. Winnebago is down 38%. Analysts cite inventory oversupply and margin compression, sterile terms that hide the human cost behind the numbers. Hedge funds unload positions before the full crash hits, taking small losses while workers face pink slips. Bond markets tell the same story. Credit spreads tied to R-vee manufacturers have widened by more than 200 basis points since last spring. That means lenders now charge higher interest because they no longer believe the industry's debt is safe. For big investors, this is just risk management. For ordinary retirees whose pensions hold manufacturing stocks, it's a gut punch. A small-town worker's 401k linked to an R-vee supplier can lose 20% overnight without warning. The crash trickles into retirement statements, not headlines. Timing has become everything, and in a collapsing market, one wrong move can turn a bargain into a trap. The buyer's clock. Every crash creates a small window where chaos becomes opportunity. Right now, that window is opening, but it won't stay open long. Historical clearance rate data from the past 3 recessions shows the same pattern. Dealers panic first, cutting prices 20 to 30% to free cash. Buyers who act too early catch falling knives as values keep dropping. Those who wait for the right signal when dealer incentives peak but financing still exists walk away with lifetime deals. Today's market is inching toward that moment. You can see it in auction data showing week-to-week stability after months of decline. Inventory still floods in, but buyers with cash are starting to nibble. The danger lies in hesitation. When the bottom finally arrives, it doesn't announce itself. It comes quietly when the last desperate dealer says yes to an offer just to cover payroll. That's the point where the smart money moves. Once the chaos slows, only a few will recognize the opportunities hidden inside it. Cash is king. In a market drowning in debt, cash is oxygen. Dealers who once dictated every sale are now begging for liquidity just to keep the lights on. Walk in today with a checkbook instead of a credit application, and you are no longer a shopper. You are the rescuer. At a dealership in Missouri, a buyer recently walked out with a 2022 Forest River Cherokee listed at $49,000. His final price? $36,000 flat plus $2,000 in service credits and a free extended warranty. The dealer confessed he had not seen a cash offer in 6 months and would have taken less just to pay floor plan interest. The power dynamic has flipped completely. Invoices that once ruled the conversation mean nothing when the dealer's main goal is survival. Cash buyers can negotiate storage, accessories, or even free delivery. The key is knowing that desperation multiplies toward the end of each month when dealers face inventory audits. For them, every unsold unit is a debt clock ticking louder. You are not asking for a discount. You are offering an escape route. And for those who cannot pay cash, the situation is even trickier because what they owe may already exceed what their rigs are worth. Equity quicksand. Thousands of families are trapped in what the industry quietly calls negative equity quicksand. During the boom years, lenders stretched R-vee loans over 15-year terms to make payments look affordable. It worked until values plunged. A family that financed a $140,000 Class C in 2021 now owes $118,000, while the same model sells for $75,000. Selling means taking a loss. Trading means burying the debt into another loan. Either way, the numbers do not work. At auction, repossessed units tell the story better than any chart. Rows of clean rigs with family stickers still on the windows sit waiting for bids that never come. These are not luxury flippers. They are middle-class buyers who believed the hype of R-vee life and now face loans larger than their vehicle's resale value. One finance manager in Ohio called it the quiet collapse because most owners do not default. They just stop using their rigs and hope the market rebounds. But depreciation never waits. Every month adds interest and reduces resale, trapping families deeper in the hole. As ordinary owners drown in debt, political forces in Washington are about to turn their struggles into ammunition for a new fight. Subscribe now, so when the next price wave hits, you'll know exactly when to buy smart and avoid the trap. Capital crossfire. When 3 million rigs lose half their value, politicians cannot stay silent. Hearings are already forming under the banner of consumer and manufacturing protection. In draft language circulating among congressional staffers, lobbyists for large manufacturers push for low-interest credit extensions and tax incentives for buyers, arguing it will stabilize small-town economies. Meanwhile, taxpayer watchdog groups are calling it what it is: a bailout for corporate greed. The divide is as fierce as the market collapse itself. Leaked lobby filings reveal a coordinated push by major R-vee associations to secure subsidies for inventory financing, not consumer relief. Their claim: without help, factories in Indiana and Ohio could close permanently, triggering mass layoffs. Lawmakers from those states are caught in the middle: defend hometown jobs or risk accusations of corporate favoritism. One draft amendment proposes a temporary tax credit of up to $5,000 for new purchases, but opponents argue it would only inflate prices again. For buyers waiting at the bottom, any artificial stimulus could erase their negotiating leverage overnight. And while politicians debate and posture, the factories that once powered an entire region are going dark, one after another. Factories fade. The heartbeat of America's R-vee industry, its factories, is fading into silence. In Indiana, entire assembly lines that roared through 2021 now echo with emptiness. One plant that produced 300 units a week has shut down indefinitely. Another has furloughed half its workforce, blaming market adjustment, while suppliers quietly file for bankruptcy. In Ohio, aluminum frame manufacturers report order volumes down by more than 60% since last year. Every closure ripples outward. The diner that fed second-shift welders, the trucking company that hauled completed rigs, the parts supplier now left with unpaid invoices. Employment data from late 2024 shows regional job losses topping 15,000, concentrated across Elkhart, Goshen, and Lima. For towns built entirely around R-vee production, that number is devastating. Local tax bases shrink, schools defer maintenance, and food banks fill up. The collapse of manufacturing is not just an industrial story, it's a community extinction event. And as domestic plants struggle, foreign suppliers step in to fill the gap with cheaper parts, further undercutting American jobs. As the factories fall silent, the story shifts. Investors see opportunity where others see loss. Main Street bleeds. The crash that started in auction yards has now reached Main Street. Retirees who once treated their R-vee portfolios as a piece of the American dream are watching them turn into anchors. Mutual fund exposure data shows that major retirement accounts tied to manufacturing stocks have lost nearly 30% of value since early 2024. The companies behind those funds, once stable dividend payers, are now bleeding from falling sales, shrinking production, and soaring debt costs. In smaller towns, the hit is even sharper. When factory jobs vanish, local economies collapse in slow motion. The cafe closes first, then the gas station, then the parts supplier. Each domino falls quietly until entire blocks go dark. For many older owners, this crash hits twice. Their investments drop in value at the same time their physical rigs lose resale worth. A Class A motorhome that represented freedom now feels like a financial weight. Yet panic selling only deepens the wound. History shows that rushing to unload assets at the bottom guarantees regret once markets stabilize. The smart move now is caution. Keep cash protected, avoid refinancing at higher rates, and wait for data instead of rumors. Because while the crowd flees from anything with wheels, a handful of contrarians are quietly hunting the forgotten rigs that will outlast the storm. The contrarian code. Every crash has two sides, those crushed by panic and those guided by patience. The contrarians belong to the second group. They don't chase discounts, they study patterns. They know that the herd always stampedes toward the same shiny names, while the real value hides in the overlooked. In today's R-vee market, those overlooked survivors are the older, simpler builds, the pre-emission diesels, the fiberglass roof towabbles, and the well-kept units under $5,000 that still run clean. These rigs may lack modern touchscreens and electric awnings, but they carry something more valuable: reliability and repairability. Proof lies in insurance data showing lower long-term maintenance costs for models built before 2015. Dealers don't promote them because the margins are slim, yet for smart buyers, they are gold. Contrarians negotiate hard, pay cash when possible, and target sellers who value speed over profit. They ignore the hype around new tech because they understand depreciation math. What's unfashionable today often becomes priceless tomorrow. A buyer who spends $6,000 on a durable classic now may still have a working rig when this entire new tech generation collapses under its own complexity. Because behind the noise of used R-vees, the electric revolution that promised salvation is starting to crack in the very same way. The next shock. The next crisis is already forming under a shiny new label: electric R-vees and vans. Manufacturers poured billions into this segment during the pandemic, promising clean travel and effortless maintenance. But now the same oversupply pattern is emerging. Factory memos leaked last quarter show inventory for electric Class B vans up nearly 200% compared to demand. Early adopters who paid premium prices in 2023 are discovering resale values collapsing even faster than gas-powered models. Batteries degrade, warranties lag, and replacement cells cost more than some entire used rigs. Charts tracking production versus sales tell the story in hard numbers. Output keeps climbing because factories need revenue, yet real consumer adoption has flatlined. Charging infrastructure outside cities remains weak, and rural campgrounds lack compatible systems. Owners report range loss, slow service times, and resale offers barely half their purchase price. It's the same movie playing again. Different technology, same greed-driven assumptions. The final stage of any collapse isn't panic, it's exhaustion, the quiet moment before opportunity returns to those still paying attention. The final wave. Every market crash ends with the same three signals: stabilization of auction prices, shrinking dealer inventory, and silence from the factories. Those signs are already appearing, hinting that the bottom may be near. Auction calendars for early 2025 show fewer repos arriving each week. The steepest drops are slowing, and cash buyers are returning in small but steady numbers. It doesn't mean recovery, it means the freefall is ending. The question now is whether you are positioned to protect, plan, or pounce. For cautious owners, protection means maintaining liquidity. Keep funds ready, but untouched. Planning means tracking clearance data weekly, not daily. Watch for consistent prices across at least 3 auctions before deciding. Pouncing means moving decisively when those 3 confirmations align. That's the real timing window, the point when dealers still cut deep, but banks haven't yet tightened the gates. Miss it, and you'll wait years for another chance like this. That's the truth. 3 million R-vees dumped, prices crashing, and dealers desperate to survive. If this opened your eyes to what's really happening, hit like and drop a comment with what you're seeing near you. And don't forget to subscribe. The next market wave is coming fast, and you'll want to be ready.